Hi guys, what's up? So this lovely Sunday morning, I'll be talking to you guys about the collapse of the Silicon Valley Bank. For those that don't know, the Silicon Valley Bank is the 16th largest bank by deposits in the United States, based in Santa Clara, California. Many of the account holders who bank at Silicon Valley Bank are venture capitalist firms and tech startups. The bank has a London arm also, and this was affected, ultimately leading to the United Kingdom seeking to obviously take control of its arm. Now, the Bank of England has had to intervene, and there are discussions as to whether or not the London arm will actually go into insolvency, or if it could potentially be revived. Bearing in mind, it's still fairly a new bank. I think maybe 2 years old in the United Kingdom, 2 years, under 3 years, I think. Anyway, I will assume that there will be further talks on Monday, so let's just see how that currently pans out. Now, with that being said, I want to discuss with you why one of the largest banks in America by deposit came to an ultimate halt on March the 10th. What happened? So what occurred at the Silicon Valley Bank seems to be ongoing. It seemed to be ongoing for quite a while prior to its actual demise on March the 10th. Things never happen overnight, and is usually a result of a culmination of things. So the first thing is that the bank invested in long-term assets as opposed to short-term liabilities, which proved to be problematic because when interest rates rose, this affected the value of their portfolio, as long-term assets took a while to eventually mature, usually 10 years. This resulted in a mismatch of liabilities and assets. Secondly, the bank had less deposits, probably as a result of public offerings and fundraising on the decline, as the tech company has been hit hard by the ongoing recession, with layoffs from companies such as Facebook, Amazon, I think, Netflix, Google, and other tech companies and startups. Thirdly, Silicon Valley Bank announcement to sell treasury bonds to realize its losses only catapulted a rush to the bank from account holders to withdraw their money, many of which exceeded $250,000. This type of scenario hasn't happened since the financial crisis in 2008 with the Lehman Brothers investment firm, even though the circumstances surrounding both events are entirely different. When did this happen? This happened on Friday, following the announcement by SVB to sell treasury bonds on Wednesday in California, and this had a domino effect really to its global arm in the UK, resulting in many startups contacting the Chancellor of Exchequer in the United Kingdom to obviously intervene promptly, as this would ultimately affect the tech ecosystems here in the United Kingdom. This is because tech startups rely heavily on cash flow in the beginning stages, because they tend to be cash negative as opposed to cash positive. Anyway, my question is now this: the Silicon Valley Bank, not regulated by Basel. For those that don't know, Basel III is an international framework that banks follow. How can this have been prevented? What does this mean for tech companies who deposited at Silicon Valley Bank? What is the threshold for the insurance provided by the banks for the money deposited in there? So the Silicon Valley Bank has now been taken over by the regulator in the United States, known as the Federal Deposit Insurance Corporation, who may possibly be seeking an outright buyer for the bank, but if that happens, nobody knows. Money deposited into the bank will be guaranteed to a sum of $250,000. Anything above that amount is yet to be confirmed. Now, there are some major players that hold accounts with Silicon Valley Bank in tech, venture capitalist firms, and businesses in the e-com world. I would name them, but given the inconvenience of it all, I don't think that would obviously be wise at this minute in time. Money held for some of these tech companies and venture capitalists and e-com banks are in the excess of $150 million. So anything above that amount is not guaranteed, as the threshold of 200,000 is currently the maximum at this minute in time. So people will be in financial limbo with these banks. So in the UK, the threshold is significantly lower. I think it's about 85,000 for a single account. A joint account is a bit more. I don't know the exact figure for a joint account. What can we learn from this whole scenario and situation? We can learn that there's a financial crisis every 10 years. It's guaranteed, and takes 1 year and a half to 2 years for the financial system to obviously recuperate. Only time will tell how the situation is likely to obviously pan out. Thanks for watching. Don't forget to comment, like, and subscribe. Take care.